This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Darius back on the show. Now, listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Go to our homepage, MacroVoices.com, and click on the red button over Darius's picture saying looking for the downloads.
Patrick, Darius had quite a few interesting market takes. What's on deck for this week's Trade of the Week?
Eric, what really stood out for me in Darius's work is just how extreme this crowded bullish positioning has become. His positioning model is sitting near the most extended levels he's ever seen, both on a mean and median basis, which statistically lines up with a much higher probability of bad outcomes over the next 1 to 3 months. Not necessarily a crash, but either a meaningful correction or some pretty violent chop as the froth gets burned off. So for this week's Trade of the Week, I want to respect that setup and walk through a way to stay broadly constructive on the cycle, but explicitly hedge the near-term positioning risk. To express that, I'm structuring a 95 by 85 put spread on the S&P 500 index. With the index around 69.20, that means buying the April 16th 6600 put, about 98 days till expiration, for about 106, and financing part of that by selling the April 5900 put for around 36. For a net debit of roughly 70 index points. Call it about 1% of the index level. Structurally, that gives you a defined risk hedge that kicks in about 5% below spot and runs protection down to roughly 15% lower. The spread is 700 points wide, so you're laying out about 70 to make up to 630 if we get a proper flush into that zone. Roughly a 9-to-1 payoff on a move that lines up very well with the kind of 1 to 3 month correction Darius is worried about, while only costing about 1% in carry to have this insurance on.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's get to these equity markets. What are you thinking here?
Well, Patrick, my view has similarities to Darius's take, but I look at this from a slightly different angle. The Trump administration is getting bolder and bolder in their policy initiatives. Now, and that's a big if they are successful in all these endeavors and pull off the objectives that they have without running into either court or opposing political party resistance and can actually achieve the things they're setting out to do, I think it's strongly positive for equity markets. But we're into regime change operations that Trump specifically campaigned to end, and now we're seeing factions of the Republican Party no longer supporting him. Meanwhile, he's just doubling down with talk of, Greenland, Colombia, Mexico, Cuba. It's almost anybody's guess as to where the next act of adventurism in the world is going to occur from the Trump administration. If the president's initiatives meet sufficient political resistance or court injunctions, that whole story could derail quickly, bringing about an abrupt and deep correction in equity markets. So my view is similar to Darius's in the sense that I think volatility will be the name of the game in 2026, with plenty of upside possible by the time it's over. But I also see a very real possibility of a strongly negative outlook, depending on how these bold policy initiatives work out, whether they're derailed by his political opponents and so forth. So I don't see it quite the way that Darius does in the sense of we'll get through the turbulence in the first few months. I think that turbulence could potentially last through the midterm elections in November, so most of the year. We'll see what happens.
Well, Eric, I want to take a look under the hood and better understand what's happening in these markets. Now, Darius has shared where we are on the state of the market, but from a price action perspective, the market is still currently behaving, making higher highs, higher lows. But what is interesting is the sector rotation that's going on underneath. On page 4, I have a chart of the Mag 7 ETF showing those 7 behemoth large market cap stocks, and the fact that they're materially not participating on the upside and in fact remain below their 50-day moving average. So overall, we're seeing that these stocks that represent 1/3 of the S&P 500 index from a market cap weighting are simply not participating in this, and is creating a drag on the market that is creating a divergent momentum. But when we then look at the rest of the market, on page 5, I have the breadth by looking at the number of stocks trading above their 50-day moving average. And we're on this index trading up at the highest level in several months, up in around 61%, while we're nowhere near overbought conditions on this, where we would trade normally up to 70-80%. But it's been improving. And so on page 6, I'm showing the S&P 500, but the equal weight index, which removes the market cap weighting and makes them all obviously equal in their influence. What we can see here is that this has legitimately bullishly broken out, demonstrating that breadth, that widening that's happening. And so what sectors have been performing? Well, over last month, basic materials are up almost 10%. The healthcare stocks have been working. The industrial stocks and defense contractors have been ripping, and the financials have been incredibly strong. So you're seeing this one component of the market driving what the technology and Mag 7s are a huge drag. And so there's a sector rotation going on. The question is this a sector rotation the theme of the next couple of weeks, or is the lack of participation of the Mag 7 an indication that the market is exhausting itself and we're going to see Darius's scenario develop? At this moment, there's no technical evidence of that, and it's probably going to need some sort of a trigger. Will something like the jobs numbers be that trigger? We're going to find out. But as of this moment, it's a market that is just sector rotating under the surface. All right, Eric, let's talk about this dollar.
I'm still in the dollar down camp in terms of overall direction, but with the big caveat that there's plenty of room for a big rip higher if certain policy initiatives on the table play out. And it seems like the president is getting less and less bashful about really bold policy initiatives, even some that frustrate members of his own party. So my overall bias is still down for the U.S. dollar, but I definitely agree with Darius that volatility is going to be the name of the game, especially for the first few months of the year.
Well, Eric, at least from the sources that I follow, there's a pretty predominant U.S. dollar bear thesis going out there. But what continues to be particularly interesting here is that in spite of all of that, there was an opportunity for the dollar index to break down below that critical 98 level to really solidify a downtrend. But instead, that support line is held. And while I wouldn't want to call this a bullish breakout on the dollar index, it's certainly strengthening off its worst levels after establishing a double bottom throughout the third quarter of the year. We have a scenario now where the dollar just isn't breaking down. It's more consolidating sideways. And so the question here is where is the next surprise move? Well, to me, I'm keeping it super simple. This 1 point range between 98 to 99 has been a consolidation area and a neutral zone the way I put in that context. And so if we had a legitimate technical breakout above 99, it would indicate that some sort of new accumulation is being introduced into the dollar that may drive a short-term trend. Will we get that breakout, or will the U.S. dollar stay in its primary downtrend is pretty much going to be decided right here as we are testing this 50-day moving average right near that 99 level. So let's see how this plays out. All right, Eric, we got to talk about oil.
Okay, I think the segment of market participants who are not oil trading professionals are frankly very badly misinterpreting the relevance and time-sensitive relevance of the Venezuelan news to the market outlook, creating an artificially bearish short-term sentiment that frankly just doesn't jibe with the actual fundamentals. Commodity markets, especially the oil market, cannot be forward-looking like equity markets. Even though people see things coming, the market has to balance supply and demand in the here and now. And the reason, particularly with crude oil, is if we don't have any place to store the oil, if too much is being produced, it leads to real problems. If not enough is being produced, it leads to even worse problems. So we've got to balance in the here and now. That means that commodity markets cannot be forward-looking, but they are subject to big swings as speculative repositioning reacts to perceptions in the market, as is happening right now. Now, the idea that Venezuelan oil is going to flood the crude oil market and crash prices starting next week is just plain silly. The first thing that happened last week was people jumped to that conclusion thinking, okay, President Trump just took all the oil from Venezuela. He's going to, send the oil companies in. They're going to start producing oil next month, and it's going to just flood the market. Our friend Dr. Anas Al-Haji took a very careful look at this. He did about an hour-long presentation on it on Twitter Spaces that is recorded and available. I strongly encourage anyone interested in the oil market to listen to that full interview with Dr. Anas Al-Haji. That's linked in your Research Roundup email. But what he said is to bring just 1 million barrels of additional Venezuelan production back online will take at least 3 years. So that's good news for the coming energy crisis, but it doesn't affect the 2026 outlook for oil prices at all, save for some repositioning overshoots as we're seeing right now. So by 9 a.m. on Tuesday, we were back up to the 50-day moving average resistance line. Looked like the market was about to break out higher because the cooler heads, the more knowledgeable oil traders, were correctly understanding that, we're not going to flood the market next week or next month with Venezuelan oil. That's a story that's years down the road, not weeks down the road. Then came President Trump's announcement that Venezuela would immediately turn over 30 to 50 million barrels of oil. Wow, that's a lot of oil. Well, actually, when you consider that we generally measure in millions of barrels per day of oil production, 30 to 50 million barrels one-time shot is not as much as it sounds like, first of all. But the question to ask then was, after President Trump said Venezuela is going to be turning over 30 to 50 million barrels of oil immediately, question everybody should have asked is, oh, well, that's interesting. Does Venezuela actually have 30 to 50 million barrels of oil that they could turn over, even if that was what was agreed to? That perception, though, that they were suddenly going to flood the market with that oil brought us back to the, oh boy, it's going to crash prices. And that led to more investor sentiment-driven selling. The dumb money started selling hand over fist, taking WTI crude back down to a 55 handle by Tuesday's close. Just one little detail nobody bothered to ask about is, do they actually have that oil? No, they don't, say both Dr. Anas Al-Haji and also our other good friend in the oil business, Rory Johnston. I reached out to both of them on Twitter, and they responded very quickly saying basically, no way. Dr. Anas Al-Haji says maybe there's 11 to 12 million barrels of floating storage in Venezuela maximum. There may also be some land-based storage, but even if they had the maximum number that anybody thinks, which is maybe 15 million barrels, that gets you to 20 to 25 million barrels total, every drop of oil that they might have. So turning over 50 million barrels next week or whatever the president announced ain't going to happen. It's still, more importantly, even if it did happen, that 50 million barrels would only really change the market for a matter of weeks before it was absorbed into the market. It's still going to take 3 years or more, per Dr. Al-Haji, in order to bring another million barrels a day of Venezuelan production online. And it's going to take lots of investment in order for that to happen. Now, it does seem like the Trump administration is poised to potentially subsidize that investment and make it happen quickly. But there's also the question of whether he will face political and court opposition to his efforts to do so. Now, to be clear, I personally can eventually see a very plausible scenario where if this is allowed to continue, it could eventually lead to the point where Venezuela really does become a game changer in the coming energy crisis that I have predicted, perhaps supplying as much as 5 million barrels a day of exports after being fully developed. What does that mean? That means that story will play out in the mid-2030s, long after Trump is out of office, and probably not on the scale that I just described of 5 million barrels a day, until after the 2032 elections, 2 more election cycles from now. So this is a long-term story if we were to really get all of Venezuela, which is the largest oil reserves, even bigger than Saudi Arabia in the world. It would take a decade and massive, tens if not hundreds of billions of dollars of investment in order to get that really happening. Our producers are already working to get both Rory Johnston and Dr. Anas Al-Haji back on the show in coming weeks. We'll get you more perspective on this oil market as this story develops.
Well, Eric, first off, we have to highlight that crude oil technically remains in a very clear downtrend. It's repetitively making lower highs and failing at the 50-day moving average when you can basically connect a descending trend line along all those highs to depict that downtrend. Now, what we are seeing, though, is negative news, and crude oil really isn't selling off hard on negative news, and it's certainly not making lower lows. And to me, if we see a scenario where there's bad news and crude oil stops breaking down on that bad news, then that means that we've found a new fair value zone for crude, and it could be a trading bottom that it is established. It's incredibly premature to make a bull call here, but one of the things to solve here in the first month of the year is are we seeing a basing formation developing on crude, or does the prevailing downtrend still take it to the next level down? Overall, it would take a legitimate breakout above the $60 level to bullishly turn this trend up, and that's still just so far away. And so there's going to need to be some real momentum shift for the bulls to even have a shot here. All right, Eric, let's talk about these precious metals. What's going on here in gold?
The sharp correction in the last few days of the year was easy to see coming, and hey, we warned you about it several times here on MacroVoices, so hopefully none of our listeners got hurt in that move. I added 10% to my longs on the retest of the breakout region at 2370, and then I added another 15% at 2300 even, so I'm now up 25% on my position size after buying this dip in size. The correction cleared out the extreme overbought stochastics. As much as the fundamentals were strong, as I've been warning for weeks, we were flashing extreme overbought on those short-term technical stochastics oscillators. That now we've gone all the way back down, at least on the slow stochastics, and almost all the way there on the RSI, to an oversold condition on the short-term chart. That clears the way for a substantive move higher, and I'm convinced that the medium to long-term fundamentals are still super bullish. The Trump administration isn't about to back away from its bold policy initiatives, and that only strengthens the argument for central banks to continue to diversify out of treasuries into more gold. But there is a short-term risk on the near horizon, so this correction that we've just seen might not necessarily be over yet. It could be that the final low is still to come, and believe me, if it gets down to 4,200, I'll be buying more. What's on the horizon is this. The Bloomberg Commodity Index is going to be rebalancing. It's a scheduled event, January 9th through 15th. Basically, what's happening is that commodity index, because gold has performed so well, it's creating forced selling for the various funds that track the BCOM index. They have to sell. It's not a discretionary thing. They have to sell, and they have to sell between the 9th and the 15th of January. So the correction that we just saw could have been front runners anticipating that move, and you never know how these scheduled things are going to play out. It's obvious, to think, oh, well, that means if they're going to sell, it's going to force the price down. But of course, people saw that coming. They were front running it. They game it, and sometimes it actually ends up doing the opposite of what you thought when the actual event happens. So we'll see how this plays out. But if we do get down to a new low, an undercut low, and especially if it gets down as low as 4,200, I'll be adding even more to my longs closer to the 15th of January when that forced selling should wind down, because I'm convinced that we are setting the stage here for the next major leg higher, targeting somewhere between 4,900 and 5,100 over the next several months. But again, that risk between now and January 15th is for potentially some turbulence in the market.
Well, Eric, there's a very clean bull trend in gold, still very well underway. Old dips keep being bought. Even that one big down day that we had was very quickly bought on dip, and gold pushed right back to its previous high. So we're in a situation where there's just no argument that the bulls remain in control of this trend. The bigger question is that are we going to see the other precious metals come under some selling pressure, and does that take a little bit of the steam out of this huge bull momentum that we're seeing, or is this thing going to just keep plugging away? Overall, there are measured moves up to 4,900, even 5,000 on the upside. And so if we can get that breakout to a 52-week high, then there's no reason why we can't tack on $300 more an ounce in the first quarter of the year. All right, Eric, let's touch on uranium and uranium stocks here.
Well, Patrick, the uranium miners mostly closed up and near their intraday highs on Wednesday, even as the S&P was modestly down on the day. And that's yet another sign that this market is heating up, and we're seeing uranium and uranium equities breaking away from mainstream stock market and really accelerating what I think is a very strong bull market that's been in a technical correction since the 15th of October. Looks like that's finally ending, and we're maybe about to break substantially higher. Let's see how that plays out. We're seeing more and more bullish fundamentals with announcements from Energy Secretary Chris Wright almost daily now coming out as he continues to talk up the formative nuclear renaissance, the strong case for increasing America's enrichment capability, which will increase demand. One of the cautions that I've described in the past for this uranium bull market is, hey, you only got a certain amount of demand that's possible based on the amount of enrichment capacity that we have, and Russia controls a lot of it, by the way. Well, as we're now aggressively building out more uranium enrichment capacity, it just speaks of more demand coming for uranium in coming years. A few names like NextGen Energy have already broken out well above their October 15th highs when this technical correction started. Others like Denison Mines are almost there. The ETFs are lagging behind, particularly the URA ETF, which has quite a few small modular reactor names like Oklo and NuScale in their portfolio. Those are not performing as well as the uranium stocks have been in the last couple of weeks. That's the reason URA is kind of the laggard there, but it has already broken out of its symmetrical triangle pattern to the upside. That ETF is particularly important because a lot of the institutional money follows that one. It's the one that has the most liquidity, and it also has the only liquid enough options chain to support options trading on the underlying uranium investments in size. So URA is a very important name in this market, and it is already starting to break out, catching up to some of its pure uranium play peers, which are already much higher. So all signs are bullish. The one big risk still on the table is the unwind of the AI trade. That would clobber all things, including uranium stocks, or all things nuclear, including uranium stocks. The bull thesis for uranium itself does not in any way, shape, or form rely on AI, but that's not how markets work. If AI unwinds, so will the uranium miners, just because of basketing of the uranium miners into AI trading baskets. And it will be a big buy the dip opportunity if it should happen.
Well, I agree with your views there, Eric. We certainly saw a technical turn up in uranium, and so it'll be very interesting to see whether the bulls can follow through, because you can see that certainly a few of these individual names are really pressing, while the URA ETF continues to drag a little bit. But when we're looking at uranium itself, this kind of $80 to $85 has been a substantial resistance point for the entire fourth quarter of the year. And so the question here is, will we see the underlying commodity start the year with a breakout to a higher high that could certainly add some bullish tailwind to the whole story throughout the first quarter? Now, I also wanted to just touch on the copper chart here on page 11, and we saw a breakout to a fresh new high, clearing that tariff pop that we had back in July, seeing the $6 handle finally hit. We're in a very clear bull market on copper, but the question is this move already a little bit overextended? Certainly, some of the upside targets for a bull continuation could see 640, 650 hit on the upside. Let's see whether the copper bulls can keep this going.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Yeah, so the 10-year Treasury yield has been in a purgatory limbo for the entire month of December, and rightfully so. Things got quiet, and there is a lot of data that is needed for the Fed to know whether to pivot on their policy path. So at this juncture, the first news will be the jobs numbers here on Friday. Now, will it be an outlier number, or is it just going to come in line? It certainly is the first trigger point that could get things moving again here. Whether or not we're going to get a breakout above the 420 level, or whether we're back under that 50-day moving average, it could be decided early next week.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.